Hey everybody, welcome. My name is Matt Heinz. I am the Director of Investor Relations here at RCF Development, and I'm proud to introduce you to our newest offering at 1182 West Boulevard. So if you take a look at the investor offering page, we have a rendering. This is the most recent rendering, a concept photo that we've received from the architect, and you will begin to recognize the design and construction aesthetic that we embrace here at RCF Development. We're focused on developing properties that are high quality, that we deliver on time and on budget, and that are attractive to potential investors, potential purchasers at the time of exit, and of course to our tenants. And it is our focus on staying in the space of building multifamily properties. We build 4-unit, 5-unit, 6-unit, maybe even as much as 10-unit properties, but we stick to that size. We stick to the mid-Wilshire type neighborhood of Los Angeles, and this focus has allowed us to become market leaders in just about 10 or 12 years, 13 years. So the property at 1182 West Boulevard is going to be a 5-unit property. It's in the mid-Wilshire neighborhood. If you take a look, there's a gallery with the artist concept photo, and of course, there's a map. And the map shows you right there at that red balloon the general area that we are building. So the beautiful thing about West is, like most of the properties that we focus on, it's centrally located. It's here in the mid-Wilshire neighborhood. It is close to downtown, close to the Miracle Mile. It's close to Hollywood, Beverly Hills, easy access to the 10 freeway. And in fact, this specific property, really what attracted us to this property in the first place is that this is a beautiful, quiet, tree-lined street. You'll notice that it's very, very close to the Queen Anne Park. Let's see if I can scroll in right there. So there's a beautiful rec center as well as a park right there. So it offers an ease of living, a convenience and attractiveness that you often don't find when you're living in an area that is so centrally located. So below the concept photo and below this video, we have a brief description of the investment as well as some property highlights. But of course, if you're interested, we have many more details located over here on our offering documents. So first of all, feel free to click on the West offering deck. It's a PDF file. If you click on it, it should initiate a download, and wherever your downloads dump, mine are here on the bottom. I can click on it and it'll bring you to our offering brochure. So this offering brochure is for our current offerings at 823 North June Street. If you haven't already taken a look, you are welcome to go back to the offering page on this website, and you will find all the information about June as well. And then we also have our current offering on West Boulevard. And then we have some information about some of our current projects, 1348 South Burnside being one of them, as well as some of our completed projects. So scrolling through, we have some information. Here's June. We have some financials, which I'm going to go over in greater detail at the end of this video, but here are some summary statistics. And of course, we have our picture of West, our current concept photo. We're working with our architects. We're finalizing plans. West is in the final stages of city approval, so we expect to break ground just after the new year 2020. Down below, we have, again, our project that is currently underway at 1348 South Burnside. And obviously, I'm biased here, but we work with, I believe that our projects are among the most attractive new developments that you will find in the entire city. We work with architects that have have a definite vision. Their vision is in alignment with our vision, and it allows us to build properties that are attractive and that is satisfying as developers. You want to build beautiful things. But of course, really the most important element of that is that attractive buildings translate to higher occupancy. We're going to experience lower vacancy. Traditionally, our properties are 100% leased at premium rental rates. And this is going to increase the cash flow that goes to our equity investors during each and every year of their holding period. And furthermore, it maximizes the sale price upon exit because people like beautiful things. So here's our property at Burnside. As always, I like to encourage people. It's finding information on a website like this is instructive. It's important, it's efficient, but there's nothing quite like touching and feeling and seeing. And I encourage you to reach out to me if you're interested, and I'm happy to take you on a tour to look at some of our portfolio properties. For example, we have a property on Van Ness, and this property is completed. It's 100% leased, and the rents are at the very, very top of the market for that neighborhood. We have a property at Plymouth, and that Plymouth property is 5 units. Again, it is 100% leased at premium rates. So this is something that we have done time and time again, and we're happy to offer you the opportunity to participate on our newest property at West Boulevard. As with all of our properties, we feature a vertically integrated organization. What does that mean? We handle everything. We are involved with the design, with the construction, with the development, and with the leasing. In our experience, that is going to minimize execution risk, meaning we have a higher likelihood of doing exactly what we say because we have experience with all aspects and all phases of the project. Our construction partner is Ocean Construction. Richard Francis, who is the managing member of RCF Development, is also a partner in Ocean Construction. Richard has been working in the Los Angeles area for over 14 years. And prior to that, he built custom homes all throughout Florida. Ocean Construction has developed an industry-leading reputation for all types of projects. They've built nearly 200 restaurants nationwide, many restaurants all throughout Los Angeles. Chances are, if you have eaten out at a restaurant in Los Angeles, you've eaten at a property that we developed. Feel free to visit the website, oceangroupca.com, and you can learn more about them. You can look at some of the projects. And not only have they built numerous restaurants, but they've built specialty projects like schools and retail showrooms. And of course, Ocean has extensive experience building custom homes and multifamily properties. And this gives us a significant advantage when it comes to developing properties that we intend to hold in our portfolio. And that advantage is the ability to time and time again deliver on time and on budget. So if we go back to RCF Development, you will also then see on the offering documents some financial projections. Now, if you watch any of my other videos, you'll notice the rhythm. In a past life, I was a professor of finance. So the financial projections are something that I spend a lot of time working on, and I always want to encourage you to kick the tires. Please, I loaded the projections as an Excel spreadsheet so that you can perform your own due diligence and you can click in each cell. I'm not looking to load a PDF or a picture. It's an Excel spreadsheet. Click around. If you have any questions, my contact info is on the bottom of this webpage, so you will see my email and my telephone number. And I encourage you, again, to challenge all the assumptions. Feel free to reach out to me if you would like to have a conversation about anything contained. I should have done that. Okay, so on the bottom, there's a number of tabs. Let's start with the one on the far left, assumptions. Okay, so as I mentioned, this is a 5-unit development, and the rents are projected to be $4,900. Right? These financial, this financial spreadsheet, these are projections. They are pro forma. They're based upon a deep experience that we have with this market, but they are built on the assumption that things in the future will very much resemble things in the past, which is never a guarantee. So our monthly gross rent of $4,900 is based upon our experience with the property at Plymouth. The property on Plymouth is at 1245 South Plymouth. Feel free to go to Google Maps. You can look up 1245 South Plymouth. You can look at 1182 West Boulevard, and I think they're about a half mile apart in the good direction. So that's a good thing. And so based upon our ability to rent Plymouth, and knock on wood, but with really, we're able to rent them very, very quickly in a matter of, as soon as the vacancy occurs, within a day, we have a signed lease at these rental rates. And so we feel fairly confident that we'll be able to rent these fairly quickly at this premium rent. We have some assumptions as far as our expenses, so property taxes, insurance, and things of that nature. As with all of our deals, We have a property management fee of 5%, and that's 5% of gross rents. Property management is what allows us to have a leasing agent and maintenance and all that kind of stuff to make sure that the tenants are happy and satisfied. And we have a fund management fee of 3%, which is, frankly, to make sure that that we abide by all of our responsibilities and our promises to you. So it allows for investor reporting and making sure that that all the checks get mailed on time. So that's fund management. So we have, based upon that set of assumptions, I can skip over to our financial analysis. So in our financial analysis, I projected out for 10 years. We have potential gross income. So it's 5 units times $4,900 per unit times 12 months. So that's about $294,000 in the first year. And that's projected to increase about 3% per year. From there, we itemize our expenses. And one of the things that I always do, that a lot of the creditors that we work with will also do, is take a look at those expenses. So if we take $74,434 and divide it by potential gross income of $294,000, our expenses are about 25%. In our experience for a new building, our expenses are generally about 25 to 27%. As that building ages, those expenses might go up to 30, 31%, 32%, something like that. So what that means is that about 75% of the income is flowing through to your net operating income. And from there, we have our mortgage expense. Our intention at this point in time is to secure permanent financing. So at the time of completing construction, when we first have our initial set of leases, we'll work with our various permanent lenders to secure an interest-only loan. In today's interest rate environment, we are seeing interest-only loans in the 3.5, 3.75% range. But of course, construction is going to take us about 16 to 18 months. So we have no guarantee what interest rates will be at that point in time. So in order to be conservative, we have allowed for an interest rate that may increase slightly to 4.25%. Consequently, an interest-only loan is going to translate to annual payments of $142,000. So in our financial analysis, we have our net operating income, our mortgage expense, and therefore we have our cash flow. Now that cash flow is going to be distributed. Now a small portion of cash flow will be reserved for a prudent reserve. But among the vast majority, probably 80% or so of that cash flow is distributable to investors, and it will be distributed to our equity investors on a pro rata basis. So just for the sake of simplicity of numbers, let's say that we did distribute all $67,000. A 10% member would receive a distribution of $6,700, and our distributions are made on a quarterly basis. Now that contributes to the cash-on-cash return for this property. So if you look at the bottom, our cash-on-cash return is very attractive. When we're looking at an environment where treasuries or something like that are paying 1% and 2%, this 6% and 7% cash-on-cash return is very attractive. But of course, cash is only one of the reasons that real estate is an attractive investment. The second reason is the depreciation benefit. So your interest expense is going to be subtracted at the entity level. So as a result, the West LLC is going to have net operating income, mortgage expense, and investors are going to receive a K1 for their share of the annual cash flow. But in addition, depreciation is going to flow through to the investors on a pro rata basis. So again, let's say that you're a 10% member. You have $9,900, 10% of depreciation, which is a deductible expense at the individual level. So this depreciation tax shield provides a very real, very tangible benefit to you that is not measured by something as like a cash-on-cash return or IRR or traditional return metrics. Okay, and of course, another reason that we invest in real estate is for equity accumulation. So down here we have projections in terms of the value of the property, and those property values are estimated based upon the cap rate. So we've made an assumption down here about cap rates. So we use a 4% cap rate, and quite simply, if you take the net operating income, so for example in year one, $210,000, divide it by 0.04 or 4%, you get a property value of $5,268,650. Now, in our experience, cap rates are not uh, the same every single year. They're generally stable, but they're not identical. So how reasonable is an assumption that they're going to be 4% forever? Well, of course, they're not going to be 4%. But here's the thing. We always want to make sure that we emphasize that our holding period is determined by maximizing returns. Sometime around year 5, we may look to exit. We're looking for windows of opportunity. We're not constrained to sell because our special purpose vehicle, our LLC, has defined a 5-year exit. No, around year 5, we'll poke our head out, take a look at property values, and if cap rates are low, in today's market for properties with this quality, really A-plus properties, we're seeing cap rates closer to 3% than to 4%. And of course, the lower the cap rate, the higher the property value. So we think that 4% is conservative. And even if cap rates go back up, our experience in this market has shown us that the cap rates will go up, they will go down, and there are windows of opportunity. We will look to maximize our exit by waiting for a time when those cap rates go down and property values are high. So we'll look at year 5. And if property values are significant, then perhaps we will exit. And if not, then we're going to hold. And we may look for an opportunity to refinance and cash out some of the equity investors. But our proposition is that we prefer to work, or in fact, we insist on working with individuals whose goal is to maximize return and consequently will think about their exit as a range rather than a single point in time. So at year 5, we will look. And if situation is not right, if the window of opportunity is not there, we may wait to year 6 or year 7 or even year 10. And when cap rates fall and property values go up, we will look to sell to maximize our exit and consequently to maximize your return. In our experience, our ability to build attractive, high-quality buildings translates to high occupancy. And as long as we are leased, we've made our obligations and we can afford to wait to maximize our exit, which maximizes your return. So down here we have some information about the cap rate. We have information about the property IRR. And of course, I have to point out as a nerd, mathematically the IRR is going to converge, right? This pattern of going down, it's just the mathematics of how IRR is calculated. But even still, by year 5, year 7, year 10, this property is generating an IRR of 18% in year 10. It's very, very significant. But of course, this is the return on the property, not necessarily the return to the investor. So we'll get to the investor returns in just a minute. Lastly, we have the debt service coverage ratio, which is significant. It's high enough that we will be positioned to secure permanent financing necessary to take out all of our construction loans. So talking about construction loans, let's talk a little bit about the project budget. On these pro formas, I use a very summary project budget. If you're interested in learning a little bit more about our construction costs, we have pages and pages of fleshed out budget that goes item by item and breaks down the cost. In general, we find that our construction works out to approximately $275 per square foot. So at this point in time, we've already acquired the land. We project some soft costs, which are based upon the period of 16 or 18 months of development. So we're going to have expenses for organization. We're going to pay architects. We're going to pay attorneys and accountants. We also have some interest associated with our construction loans and property taxes and insurance and things of that nature. We have construction costs. And of course, we set aside, in this case, 10% for contingency because sometimes unforeseen things happen. We have a strong ability and demonstrated ability of building on budget based upon that original $2.2 million, but it's always prudent to have some money set aside as a contingency to make sure that you can reach the finish line. So we have a total of $3.88 million that's going to be necessary to get us to the finish line. And that's where the capital stack comes in. So in terms of the capital stack, with this investment, we're seeking to raise $1,020,000. At this point in time, the LLC already owns the land. We already have nearly completed architectural plans. So this project is being introduced to equity investors at a little bit later stage or a little closer to being shovel ready than many of our previous projects. So we've incurred significant costs to get the property to that point in time. So this deal is going to be structured as follows. Limited partners being offered a 50% share. Okay, and the way that works is that each unit, 5%, which is the minimum investment, translates to $85,000. And so for 50%, that is a total of $850,000 worth of investment. In order to recoup the expenses that they've incurred to date, the general partner is going to receive 40% ownership, and then the sponsor, which is RCF Development, is going to contribute $170,000 for an additional 10% interest. So the total raise is $1,020,000, and we're going to then, from that, have a developer fee and an acquisition fee. And as is typical with our deals, the developer fee is 5%, the acquisition fee is 4%. These are based upon the deal size, the project budget, not the equity. So the capital stack is going to then be structured as follows. We're looking to secure a $1,020,000 equity investment. We have construction financing in place that was already secured, which the liability will be transferred to the West LLC entity at $880,000. At the beginning of the year, once this project is shovel ready and we're ready to begin construction, we will secure additional construction financing from Goldman Sachs, and that will allow us to get to the finish line. At the end of construction, we will look to secure permanent financing from one of our partners on an interest-only basis that is sufficient to take out our construction loans. I have a capital and fees timeline that just walks through the timing. This is kind of, for me, a construction equivalent of a statement of cash flows. You want to make sure that you have enough cash to write the checks, not just enough money to have profit or net operating income. You have to have enough cash to write the checks, and that's the purpose of this, and feel free to take a look. We went through our financial analysis, and so lastly, that brings us to our projections. I've highlighted the 5 and 7 year returns. This is a simplified investment projection matrix. So on a hypothetical 10% member, they will receive 10% of the cash flow. That tax benefit is estimated based upon the depreciation and an assumed marginal tax rate of 40%. Most of our investors, being accredited investors, are in high tax brackets. Most of our investors are in California, therefore they also face California income taxes. So 40% may be understated. It may be closer to 50%. And the higher the tax bracket that you're in, the more significant, the higher the benefit to you is of that depreciation flow through. Okay, but anyway, so if you put those two together, you can also then calculate what I've called the effective annual income. Really, it's equivalent to your change in wealth, not just the money into your pocket, but also the money saved because of the tax benefits. What do I always like to quote here? Benjamin Franklin. A penny saved is a penny earned. Very real. So for a hypothetical 10% investment, your initial investment is $170,000. You will earn some cash flows each year. And then lastly, there's an equity cash out. So the equity cash out is based upon the difference between the assumed property value and the mortgage balance. And then I multiply times 0.93 because we have a 7% fee at the time of exit to cover brokerage costs and marketing and all that kind of stuff. So if we take a look at a single number just as a representation, here we have an equity cash out plus accumulated income of $279,000. So based upon these projections, if you were to sell in year 5, you'd receive $239,000 at the time of your equity cash out, plus you will have received all of those cash flows in year 1, 2, 3, 4, and 5 for total income of $279,000. And again, this is just a simple measurement of returns. This is not, based on time value of money and internal rate of return and all that stuff. It's a simple return measure. So if I take a look at $279,000 of ending wealth versus $170,000 initial investment, that's a 64.42% return. If you divide by 5, that averages to 12.88% per year. I think it's also illustrative to take a look at the last two columns, which include the depreciation tax benefit. So there's your effective return and your average annual return if you also incorporate the depreciation benefits. Okay, so that's why on this page, our holding period is plus or minus right around 7 years. So that's where I got the 13.79% projected return for this property. Okay, so going back to the website, If you like what you see and you are ready to move forward, feel free to click the Invest Today, and that'll walk you through. If you have any questions, my contact info is right down here at the bottom. And as always, don't be shy. If you would like to learn more, please send me an email, call me on the phone, arrange a tour of our current portfolio. They speak for themselves. I appreciate your time taking a look and considering this project. If this project is not necessarily for you, we welcome you to take a look at some of our other offerings. We're always open to new opportunities. We're always developing new properties and new projects. And so this webpage will change on a frequent basis. So right now we have Burnside, which actually just completed. It says open because I haven't gone into the admin dashboard and updated it. So this has been fully subscribed. We have the property at West, which you've been watching this video for. We have the property at June, and we welcome you to take a look from time to time. If the timing is not right today, or if this opportunity is not ideal for you, then perhaps we'll have something that works a little bit better for you in the near future. Thank you again, and have a wonderful day.